I've been staring at this chart for the past 2 hours, and what I'm seeing is making my stomach turn. My name is John. This is The Hidden John, and it's Sunday, April 12th, 2026 at 7 p.m. Eastern Time. In exactly 5 hours, Shanghai opens. In 7 hours, Tokyo opens. In 13.5 hours, New York opens. And the technical pattern that has formed on silver's chart over the past 3 weeks is identical to the setup we saw on March 22nd, the day before silver crashed 26.9% in a single session. If you own silver, if you're thinking about buying silver, or if you have any exposure to precious metals right now, you need to see what I'm about to show you because the parallels are absolutely terrifying. Let me start by showing you the chart pattern itself, and then I'll explain why it matters and what it's predicting. From March 26th to April 8th, silver formed what technical analysts call a cup and handle pattern. The cup started at $67.75, rounded up to $77.31, and then formed a handle that's been consolidating between $73 and $77 for the past week. In classic technical analysis, a cup and handle is a bullish continuation pattern. When the price breaks above the neckline, which in this case is 77 towards 73, the measured move target is the depth of the cup projected upward. The depth from 67.75 to 77.31 is 9,056. Add that to the breakout point of 77.73, and you get a target of 87.29. That's the bullish interpretation, and it's what every YouTuber and technical analyst has been telling you for the past week. Silver is setting up for a breakout to $100, they say. The cup and handle is forming perfectly, they say. But here's what they're not telling you. Cup and handle patterns fail 38% of the time. When they fail, when the price doesn't break above the neckline and instead breaks below the handle, the pattern inverts and becomes one of the most bearish setups in technical analysis. It's called a failed cup and handle, and the target for a failed pattern is a return to the base of the cup, which in this case is $67.75, or even lower if panic accelerates. Now let me show you why I think this pattern is going to fail. There are 4 specific technical indicators that are all flashing warning signals right now. First, the relative strength index on the daily chart is showing hidden bearish divergence. On April 8th, silver made a higher high at 77.31 compared to the April 2nd high of $76.15. But the RSI on April 8th was at 58.4, which is lower than the RSI on April 2nd of 61.2. When price makes a higher high but RSI makes a lower high, that's hidden bearish divergence. It means the momentum behind the move is weakening and the rally is likely to fail. Second, volume during the formation of the handle has been declining every single day. On April 8th, when silver hit 77.31, COMEX volume was 187,400 contracts. On April 9th, volume dropped to $161,200. On April 10th, it was 148,800. On April 11th, just 98,300 contracts traded, which was a Friday before a long weekend, so low volume is expected. But the trend is clear. Declining volume during a consolidation phase suggests that buyers are getting exhausted and don't have the strength to push through resistance. When volume contracts like this, breakouts tend to fail and breakdowns tend to succeed. Third, the moving average convergence divergence indicator, the MACD, just printed a bearish cross on the daily chart. On Friday, April 11th, the MACD line crossed below the signal line. This is the first bearish MACD cross since March 25th, which was one day before silver bottomed at 67.75. Now, a single MACD cross doesn't mean the trend has reversed, but combined with the RSI divergence and the declining volume, it's adding weight to the bearish case. Fourth, and this is the most terrifying part, the handle of the cup is forming a descending triangle pattern. A descending triangle is characterized by a flat bottom support level and a descending top trend line. In silver's case, the flat bottom is at $73.50, and the descending trend line connects the April 8th high of 77.31 with the April 10th high of 76.98. Each time silver tries to rally, it makes a lower high. That's the definition of a descending triangle. And here's the critical fact. Descending triangles resolve downward 72% of the time. When the price breaks below the flat bottom support, the measured move target is the height of the triangle projected downward. The height of this triangle is 77.31 minus $73.50, which equals $3.81. If we break below $73.50, the measured move target is $73.50 minus $3.81, which equals $69.69. But here's where it gets worse if we break $69.69 with momentum. The next support level is $67.75, the March 26th low. And if that breaks, we're looking at $61.76, the March 23rd intraday low. So the technical setup right now is a failed cup and handle combined with a descending triangle. And if both patterns trigger, we could see silver fall from the current 75.60 level all the way to $61 or lower. That's a potential decline of 19.3%, or nearly 15 $15 per ounce. Now let me show you the historical precedent that makes this even more terrifying. On March 22nd, 2026, silver was trading at $84.20. The chart looked constructive. We had just bounced off support at $78, and it looked like we were setting up for another leg higher toward $90. But there was a descending triangle forming on the 4-hour chart that almost nobody noticed. The flat bottom was at $82.50, and the descending trend line was connecting lower highs at $86.30, $85.40, and $84.80. At 6:30 p.m. Eastern on March 22nd, after the regular COMEX session closed, silver broke below the 82.50 support level in thin Globex trading. By 11 p.m., it was at $78. By 4 a.m. on March 23rd, when London opened, it was at $72. And by 9:30 a.m., when the COMEX pit session opened, it had crashed to 61.766. In less than 15 hours, silver fell 26.9% from the triangle breakdown level. The pattern we're seeing right now on April 12th is a larger version of the exact same setup. The descending triangle is forming on the daily chart instead of the 4-hour chart, which means the potential move is bigger. The flat bottom support at $73.50 has been tested 3 times in the past week, once on April 7th, once on April 9th, and once intraday on April 11th. Each test held, but barely. Technical analysis teaches us that support levels get weaker with each test. The first test is usually strong, the second test is weaker, the third test is critical. If we get a 4th test of $73.50 and it breaks, the flood of sell stops that will be triggered could create the exact same cascade we saw on March 23rd. Now let me show you the order book data that confirms massive selling pressure is building just below current levels. I have access to COMEX depth of market data through my trading platform, and as of Friday's close, here's what the order book looked like. Between $75 and $75.33, there were buy orders totaling approximately 4,200 contracts, or 21 million ounces. Between $74.50 and $75, buy orders dropped to about 2,800 contracts, or 14 million ounces. Between $74 and $74.50, only 1,600 contracts, or 8 million ounces. Below $74, the order book is basically empty until you get down to $70, where there's a cluster of about 3,500 contracts. What this tells you is that there's very little buying support between $74 and $70. If we break $74, there's almost nothing stopping a fall to $70. On the sell side, there are massive sell stop orders clustered just below key technical levels. At $73.45, just below the triangle support of $73.50, there are sell stop orders totaling approximately 8,900 contracts, or 44.5 million ounces. At $72.95, there are another 6,200 contracts. At $69.95, there are 11,400 contracts. What this means is that if we break $73.50 and trigger those stops at $73.45, it will create 44.5 million ounces of forced selling that will overwhelm the buy orders and push us down to the next cluster of stops at $72.95, which triggers another 31 million ounces of selling, which pushes us to $69.95, which triggers 57 million ounces more. It's a cascade. Now let me connect this technical setup to the fundamental catalyst that could trigger the breakdown. The Islamabad talks failed. That's now confirmed. Vice President Vance left Pakistan on Sunday morning after 21 hours of negotiations with no deal. Iran refused to commit to giving up nuclear weapons, which was the core U.S. demand. The temporary ceasefire expires on April 22nd, which is 10 days from today. And as of Sunday afternoon, there's no framework in place to extend it and no follow-up talks scheduled. Iran's Supreme Leader Ayatollah Khamenei released a statement earlier today saying, "The ceasefire will be evaluated based on the actions and commitments of the opposing side," which is diplomatic code for "we might end it early if we don't like what you're doing." And here's what the U.S. is doing. As of Sunday evening, there are now 4 U.S. Navy destroyers in the Strait of Hormuz conducting mine-clearing operations. Iran views this as a provocation and has threatened to attack those ships. If Iran fires on a U.S. destroyer in the next 24 to 48 hours, the ceasefire ends immediately. Oil spikes from $97 to potentially $130+ per barrel. Inflation expectations explode. Fed rate cut, hopes die. And commodities, including silver, get hit with massive liquidation selling as funds reduce risk exposure. That's the fundamental catalyst that could break the $73.50 technical support level and trigger the cascade I just described. And here's the timing that makes it so dangerous. Shanghai opens at midnight Eastern tonight. Tokyo opens at 2 a.m. London opens at 3:30 a.m. New York opens at 8:30 a.m. If negative news hits about Iran between now and the New York Open, the initial selling will happen in the Asian and European sessions when liquidity is thinner and moves are more exaggerated. By the time New York opens, we could already be down $3 to $5, and the stop cascade could be well underway. Let me now show you the Elliott Wave analysis that adds another layer of fear to this setup. Silver's entire rally from the COVID low of $11.62 in March 2020 to the all-time high of $121.67 in January 2026 can be counted as a complete five-wave impulse structure. Wave 1 went from $11.62 to $30.35. Wave 2 corrected to $21.93. Wave 3 extended from $21.93 to $87.54. Wave 4 corrected to $40.23. And Wave 5 went from $40.23 to $121.67. Classic Elliott. Wave theory says that after a five-wave impulse completes, a three-wave correction follows. That correction is typically labeled ABC. The crash from $121.67 to $61.76 was Wave A 49.2% decline in 53 days. The rally from $61.76 to $77.31 was Wave B, a 25.2% rally in 13 days. If this is indeed a Wave B rally, Elliott Wave theory predicts that Wave C will be approximately equal in magnitude to Wave A, which means a decline from $77.31 to somewhere in the range of $35 to $40. Now, I'm not saying silver is going to $35 this week, but I am saying that if the Elliott Wave count is correct, and if we're at the top of Wave B right now, we should expect Wave C to begin very soon, and the initial leg of Wave C could easily take us back to the $60 to $65 range. Now let me show you the commitment of traders' data that supports the bearish technical setup. As of Tuesday, April 7th, which was the most recent QOT report, commercial traders, who were primarily the big banks, held a net short position of $109,400 contracts. That's their largest net short position since January 14th, which was just 2 weeks before silver topped at $121.67. Historically, when commercials build large net short positions, it's a sign that they believe prices are too high and are likely to fall. Commercials are the smart money in the futures market. They have better information, better models, and better risk management than the speculators. On the other side, managed money traders, which are hedge funds and CTAs, held a net long position of 23,400 contracts as of April 7th. That's actually down from 28,400 the previous week, which means hedge funds were reducing their bullish bets even as silver was rallying. When both commercials are increasing shorts and managed money is reducing longs, that's a double bearish signal. It means the smart money on both sides is betting against higher prices. Let me give you the specific scenario timeline for how I think this could play out over the next 48 hours. Tonight, between midnight and 3 a.m., Shanghai and Tokyo open. If both markets open weak, if we see immediate selling pressure that pushes Shanghai below 610 yuan per kilogram, which is about $82.50 per ounce, that's your first warning sign that the technical breakdown is in motion. Between 3:30 a.m. and 8:30 a.m. London trades. London is critical because it's the largest physical silver market, and the LBMA spot price is often a better indicator of true supply demand than COMEX futures. If London breaks below $74, that confirms the Asian weakness and sets up New York for a gap down open. At 8:30 a.m. Monday, New York opens. If we gap down to $74 or below, watch the first 30 minutes very carefully. If there's no bounce, if selling pressure continues, and we break $73.50 in the first hour, that triggers the stop cascade I described earlier, and we could be at $70 by noon. If we somehow hold $73.50 through Monday's session, we get a brief reprieve, but then Tuesday at 8:30 a.m., we get the March PPI data. If PPI shocks to the upside at 0.7% or higher, that could be the catalyst that finally breaks $73.50 on the second attempt. And here's the ultimate nightmare scenario. We break $73.50 on Monday, triggering stops down to $70. We bounce slightly from $70 to $72 on short covering. Then Tuesday's PPI comes in hot, and we break $70 on the second leg down. Below $70, the next support is $16.75. If that breaks, there's almost nothing until $61.76. We could see a move from $75 to $61 in less than 48 hours if both catalysts hit in sequence. That's an 18.5% decline, or $14 per ounce in 2 days. Now, let me give you the bull case because I don't want you to think I'm just fear-mongering. The bull case is that the cup and handle is legitimate, that the Islamabad failure is already priced in, and that physical demand from Asia is strong enough to support prices at current levels. If we can hold $73.50 through Monday and Tuesday, and if PPI comes in below expectations, The technical setup actually flips bullish very quickly. A break above 77.73 on strong volume would negate the descending triangle, invalidate the bearish Elliott Wave count, and open the door to the measured move target of $87 or higher. But here's why I'm focused on the bear case tonight. The probabilities favor downside based on the weight of evidence. We have 4 technical indicators signaling weakness, a historical precedent from March 23rd showing how fast silver can fall when a similar pattern breaks, order book data showing massive stop clusters below the market, fundamental catalysts from the Iran situation that could trigger fear-based selling, Elliott Wave suggesting we're at the top of a corrective rally, and commitment of traders data showing smart money is positioned bearish. Against all of that, the bull case is primarily based on hope that the pattern holds and physical demand saves the day. Here's my personal plan for the next 48 hours. I'm holding all physical silver regardless of what happens. Physical metal is for long-term wealth preservation, not short-term trading. But I'm setting very tight mental stop losses on any paper positions. If $73.50 breaks on strong volume, I'm out immediately. I'm not trying to catch a falling knife. I'll wait for $67 or $62 to think about re-entering. I'm also preparing dry powder, cash on the sidelines, to deploy if we do get a panic. Flush to $65 or below, because at those levels, the long-term value proposition for silver becomes overwhelming even if the short-term technicals are terrible. This is the Hidden John. It's 7 p.m. on Sunday, April 12th, 2026. The chart is flashing a terrifying signal. The technical setup is identical to March 22nd. The fundamentals are deteriorating with the Islamabad failure and potential ceasefire collapse. And we're 5 hours away from the Shanghai Open. I don't know if the Sunday night massacre is coming, but I know the setup is there. And I know that when patterns like this break, they break violently and without warning. I'll be posting real-time updates on the community tab through the Asian and European sessions. Stay safe out there.